Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Julie Hyman this morning. Let's get to the three things that you need to know today.
First up, President Trump's tax bill is headed to the Senate. The multi-trillion-dollar package narrowly passed the House this morning after Republican leaders released a new version of the bill that would speed up cuts to Medicaid and included a higher limit on state and local tax deductions. The bill would avert a year-end tax increase but would add to the U.S. debt burden. It now heads to the Senate, where groups of Republicans are pressing for extensive change.
Plus, in the market, Treasury yields soaring and adding pressure to risk appetite. The 30-year bond yield trading close to its highest level since 2007 amid growing deficit concerns with the president's tax bill heading to the Senate. Now, stock futures falling in tandem with bonds amid growing fiscal risks here in Washington. We are mixed right now.
And the Bitcoin rally powering on, the digital asset hitting fresh highs of 111,000 above right now. That's the first time that it has seen that level. Traders have grown increasingly bullish on the prospects for Bitcoin amid mounting institutional demand and support from President Trump's administration, with key stablecoin legislation growing closer to a passage in the U.S. Senate. Bitcoin's latest milestone coming as Trump prepares to meet with the biggest holders of his meme coin at a dinner at his golf club just outside Washington later today. The U.S. House of Representatives narrowly passing President Trump's signature tax bill this morning, where it will now head to the Senate. Lawmakers expected to press for extensive changes on arrival, with passage not expected until August. That's when Treasury Secretary Bessent said debt limit measures could run out. Bonds were resuming their sell-off as investors assess deficit risk in Washington, with the bill including a $4 trillion increase in the U.S. debt ceiling. Joining us now to break down what all of this means for investors, Willem Sells, HSBC Global Private Banking and Wealth Global CIO. Willem, it's nice to see you. So we have seen perhaps the bond vigilantes come out, as they are sometimes referred to. We have definitely seen concerns start to creep back in about deficits. How sustained do you think this move in treasuries could be in the U.S., and then sort of the ripple effect throughout the equity market?
Yeah, it's interesting how markets sometimes, need a new narrative. And I wonder actually what is so new about this. We know that Moody's had been looking at the rating for quite a while. It's also the third rating agency to act. So usually people are more surprised by the first and the second. The debt pile and the debt issues are not, are not new. I don't want to gloss over this, but if you look historically, there is almost zero correlation between where bond yields are and the level of debt. Look at the experience in Japan. I would rather look at where is inflation going? So I think the market will move from the current narrative to the outlook for inflation. And obviously, there tariffs play an important role.
And so with regard to the kind of broader tradable moment that investors were looking for over the course of this year, I mean, coming off of tariffs, it seemed like many of the investors that we spoke with were saying, okay, well, the next big event that you could look towards is some of the big, beautiful bill movement there and what that could eventually mean as a tradable moment. But are these things actually playing out as tradable as expected coming into them?
So the equity market was, quite excited about, taxes being cut, and took the positive took the positive angle on that earlier this year. But of course, unfortunately, the market has started to look more at the, the budgetary impact of any tax cuts, and therefore, sort of the upside of a very generous bill has been reduced for the equity market. So I now think that what we will now need to see is really, the impact of tariffs on growth, whether or not we see that bigger impact. And I do think that evidence will also be mixed. It will probably take quite a long time before we see it in economic data. So, for example, there are those that argue that consumers and businesses are going to freeze, are going to be slow and take a wait and see approach. Others are arguing that consumers may actually front load some of their purchases if they believe that, after the 90-day reprieve, those tariffs could go up again. So you will see very, very mixed data. The way for investors to handle this is to buy companies that are solid, to look for quality, and to look for those companies that are supported by very strong structural trends like AI, for example.
Well, and it's interesting, Willem, because as we saw a little bit of relief on the tariff front, you all did go back to your overweight on the U.S. more broadly here. So it looks like you're taking the sort of glass half full side of the equation you were just describing, but it sounds like it's a qualified glass half full. In other words, if you are talking about buying specific companies and still being choosy in the market. So you wouldn't just sort of go wholesale into things right now, given some of the risks you were describing.
That's correct. I mean, we have to acknowledge that the data are going to be volatile, but two-way volatility, as I just mentioned, in terms of those headlines. So therefore, you need to weather that short-term volatility. There's also every single company is very, very different in terms of how they are going to be affected by tariffs and by slow but still positive growth. So we are certainly not in the recession or the stagflation camp. But as every company is different, the equity analysts on your show are going to be very valuable because they are going to look at who is more exposed in terms of their supply chains, who has the better product that can continue to see that very strong demand. Obviously, also beyond just picking the quality stocks, it's also finding multi-asset diversification. Gold is obviously still continuing to benefit from all of this. But even bonds, right? Because you have can at least provide you a stable, solid income stream, and that one already dampens your volatility, and you have a very strong real yield. So the minute the market pays a little bit less attention to the deficit, or you have some stability in terms of inflation, but that real yield potentially can come down.
What are you seeing in terms of rotation from some of your wealthiest clients here, especially within the wealth management side of the business, as you're thinking about them typically having the ability to front run anytime we've seen a shift in the mindset among investors from risk off to trying to get back risk on, where the wealthier clients, they have an ability to perhaps, put some pieces into play a little bit earlier on within that?
So, in terms of rotation, there is a lot of talk of people, getting out of the U.S. markets into others. There is only very scant evidence of this. Institutional investors are already very underweight on U.S. equity, so I don't think you will have a much more of a sort of geographical rotation away from the U.S., but you will have diversification flows. In terms of opportunistic trades by our clients, clearly they are doing that stock picking that I just described, sometimes with downside protection, so volatility strategies. There's a lot of interest in gold still, in short-dated bonds as well, and then in alternative assets. So to take that longer-term exposure, because a lot of private investors obviously can take advantage of the somewhat lower valuations that you have and take that longer term call on really strong businesses. All
right, I guess I'll keep an eye on some of their Christie's and Sotheby's bids for some of those alternative assets as well. Willem, thanks so much for taking the time.
Thanks for having me.
JP Morgan CEO Jamie Dimon warned that the U.S. economy may fall into stagflation as a result of high deficits, policy pressure, and geopolitical uncertainty in an interview with Bloomberg. In appearances this week, Fed officials stressed the need for more hard data before reducing rates, downplaying the likelihood of a June or July rate cut. Our next guest says the Fed should lower policy this summer to preserve U.S. expansion. Here to explain, we've got Simona Mokuda, who is the State Street Global Advisors Chief Economist. So take us into your thinking around why they should look at June or July and what that overall sets them up for the totality of cuts that you're anticipating this year.
Sure. I have to say there is very much a sense of deja vu. We made the same argument last summer, and the Fed, of course, was reluctant to follow through with the summer cuts, and then they came back in September with a larger move. I feel there's a decent chance we might be going into a similar scenario this year. And the reason I do think the Fed should cut despite tariffs is that the labor market and the economy as overall, I would argue, is at a much more delicate point today than a year ago. The labor market is in balance, but labor demand continues to weaken. So I think the pressures from here on are towards more softness, not drastic deterioration, but there is more stuff that it's already baked into the pie, so to speak, with some of the Doge moves that may not hit payrolls data until later in the fall, with some of the funding cuts that will have repercussions, but you may not yet see them in payrolls. So all eyes right now are on the inflation side of the Fed mandate. I'm a little bit more about the labor part, and that is the critical element in the economy, because the economy avoids recession if consumer spending remains strong, and that can only happen if the labor market remains strong. So it's an argument of managing both risks and perhaps accepting that whatever hit from tariffs we may have on inflation, which again, the picture is changing every week, and we don't know that, but the more steady trend of softening in the labor market is the one that should be paid more attention to.
And Simone, now we were just showing the Treasury market. Now we have, in particular, 30-year yields ticking well above 5% at this point. I'm curious what economic effect you see from that, and how sustained it has to be. In other words, do 30 years have to remain above 5% for it to have more of an effect, for example, on the housing market or on corporate borrowing costs?
I think we have a clear fiscal sustainability challenge that needs to be addressed. However, you probably also don't want it to be addressed all at once, because after the fiscal feast of the post-COVID period now, I don't want to go directly into famine, but you want to manage the fiscal trajectory. Sustain long-term interest rates at these levels or even higher would really dampen the economy's ability to grow. So I am hoping that we, from here on, pursue a more growth-oriented agenda. There is a lot still that can be done on deregulation and so forth. But if you come back to what does this mean for the Fed itself, you can argue, well, the market is doing a little bit of the lifting for the Fed, right? Higher long-term yields perhaps does allow the Fed to actually offer a little bit of relief. And again, we are talking from a place where policy is still restrictive. So I think, in fact, for the Fed, it creates a little bit of an opening. The challenge for the Fed is, the news flow on tariffs and the uncertainty thereof.
I guess it's interesting because policy restrictive, as you were mentioning, but as we were coming into the year, and still much of the narrative has been around some of the resiliency to this point without a larger trend of major cracks showing up that would push the Fed to more aggressively institute cuts at this point. So what is the risk of them cutting too soon with the absence or without the presence of that longer trend that they're looking for?
So I'm glad you showed briefly that chart that showed the Fed funds rate and nominal GDP growth. And those two at this moment are pretty much on top of each other. In expansion periods, Fed funds as the ultimate low risk, interest rate metric should be substantially below GDP growth, nominal GDP growth. And you can think of it, it's not a complicated modeling issue, but just think of it, the cost of capital versus a proxy for return of capital. Cost of capital, Fed funds, return on capital, nominal GDP growth. At this point, there is no headroom there. There is no incentive to invest at this rate. So there is a lot of debate among economists about what is the neutral rate. This chart is independent of any arguments around neutral rate. It's telling you, in the context of today's economy, interest rates, the Fed policy setting is tight, and typically this level of tightness preceded recessions. If you look going back to the last few recessions, this has always been the case. So this is why I opened by saying this is a delicate moment. I do not want to dismiss the fact that the Fed, of course, needs to take into account inflation, but inflation, I would prefer a little bit higher than target inflation without a recession than exactly a target inflation with recession, because I also have to believe a recession worsens the fiscal picture in and of itself, right? The counter-cyclical support measures that have to be pushed through. So it is complicated. At the end of the day, I think every economist might develop their own advice for the Fed here. Mine is that you should not be afraid to cut. We are not talking here, hundreds of basis points, but, calibrate policy rates lower. We expect 75 basis points worth of cuts this year, whether they happen in small increments or a 50, at some point, I think it's less relevant.
Gotcha. The risks skewing in that direction. Simona, thank you so much. Appreciate it.
My pleasure.
Coming up on Morning Brief, we count you down to the opening bell on Wall Street. Plus, we'll break down Bitcoin's record rally as the token powers to new highs. And President Trump says he is seriously considering taking Fannie and Freddie public. We'll bring you the details next on Morning Brief.
It's now time for some of today's trending tickers. We are watching Nike, BYD, Tesla, and Snowflake here. First up, Nike says it will sell items directly on Amazon for the first time since 2019. Shares moving slightly higher ahead of the market open. In separate news, Nike is planning to raise prices on some items as soon as June 1st. The increases range from $2 and $10 per item and will not apply to children's merchandise or items under $100. Shares right now moving higher by about 1.5%, at least on the retail resumption in some of those partnerships here, especially coming after the tie-up most recently between Dick's and Foot Locker, two of their biggest wholesale partners here. As you're thinking about what Amazon would give them and this deal and partnership that they've had with Amazon previously, they kind of went back into that direct-to-consumer strategy and really brought more of that closer to the vest and then cut off some of those other channels that they were selling into, trying to increase some of the brand value, price controls as well. And now, under Elliott Hill, you're seeing kind of a reversal of that strategy here. Had the opportunity to actually meet him over the weekend, and it was really good, interesting to see how the team is rallying around some of the strategy as well.
Yeah, to come back to those wholesale channels. It is interesting. Two things to mention here with this new renewed partnership with Amazon. First of all is that as part of it, Amazon apparently has promised to redouble its efforts on counterfeits and non-Nike sold sneakers on the platform. So that's thing one, because that was one of the reasons that Nike had pulled back from Amazon in the past. Thing two is how it will affect potentially some of the other wholesale partners. There was an interesting note this morning from John Zalides over at Quo Vadis Capital, where he said, this could be negative for the likes of a Foot Locker and a Dick's if people are going to be going to Amazon and not to those channels, and even perhaps to Academy Sports as well. He's not a bull on those, but we're not seeing a big reaction this morning, but it's something to continue to watch here because those labels, especially Foot Locker, are so indexed to Nike.
For those wondering which shoe the Nike CEO wears, it was the Kobe Mambasitas, actually. So.
I have to Google that.
Yeah,
I don't know off the top of my head what those look like. And next, Chinese automaker BYD outselling Tesla for the first time in Europe in the past month. That's according to research from Jado Dynamics. BYD's EV sales jumped 169% in April, making it one of the top 10 EV producers in Europe. Meanwhile, Tesla sales fell by 49% in the past month, and they were down 30% in the first 3 months of the year. Now, these two are really neck and neck here. We're talking about BYD with 7,231 vehicles here, so really just inching out Tesla with 7,165. What's interesting to me here when you look at these numbers from Jado Dynamics is that we just had Elon Musk speaking to that big conference in Qatar and saying, well, everybody was down in Europe over the past couple of months, and clearly that's not really the case, particularly with EVs. The Volkswagen Skoda brand in particular in EVs has been doing well, but interesting to see that gaining of BYD in particular.
Yeah, some of the big numbers that stuck out to me from the Jado Global analyst here. Tesla reporting a 49% year-over-year drop in total volumes in April. You compare that to BYD and what took place, an increase of 359%. And then additionally, what makes this even more remarkable...
359% includes the hybrids as well, so it's all of those BYD cars.
Correct. But more interesting as well is that BYD only got into this region back in 2022. So essentially over the course of the past, you count them on one hand, number of years here as we're thinking about how quickly this company has ramped up, stolen some of that market share, but then also, of course, within the regions that they're operating, trying to bring on even more of the manufacturing power in those specific regions so that they don't get hit with as many tariffs as all of the auto manufacturers are thinking about. I think that's what really is remarkable as we're taking a look at the year-to-date move here, up by about 74%.
Yeah.
Finally here, tracking Snowflake raising its full-year product sales guidance and issuing an earnings beat for the first quarter. Shares of the cloud storage company, they are moving higher this morning. This was Snowflake's first ever quarterly sales above $1 billion. It's now anticipating yearly product revenue of $4.33 billion. Shares higher pre-market by about 8.4%.
Yeah, a lot of the company's AI-related products, it's using this data to train some of that. That's really apparently what it's leveraging here, one of the things that has been driving the sales. Well, TD Bank planning to cut 2% of its workforce as part of a restructuring plan. This after Canada's second largest lender topped second quarter earnings estimates, boosted by lower than forecast credit provisions and increased trading activity due to market volatility. Joining us now, Chris Whalen, Whalen Global Advisors chairman. So interesting to see this. The news about the restructuring is not new. The news about how many people they're cutting as part of this is new. But how do you view TD's positioning overall, Chris?
I have always thought that getting into retail banking in the United States was a mistake for TD. They're an asset manager in Canada. That's what they do well. And they had a big stake in Schwab, which they just sold. They took the gain in this quarter. I would have done the opposite. The history of Canadian banks investing in U.S. retail banking institutions is very mixed and frankly negative. It's been a destruction of shareholder value going back decades. And I just think that all banks today are looking for growth, one way or another. You saw this with Goldman Sachs going into Marcus and white label credit cards with Apple. You've heard this from Jamie Dimon. He doesn't have enough use for capital. He wants to give it back to shareholders. It's hard to restrain management when they're looking for growth. And so the natural thing is, well, we'll go buy some retail banks in the United States. They paid too much for them. You can see the goodwill on the books of the U.S. bank. They have a $500 billion U.S. operation now. And of course, they had the big anti-money laundering problem. So I think overall, it's time for them, I think, to step back and say, what are we trying to achieve in the U.S.? Are we ever going to hit our target equity return hurdles by being in a retail bank in South Jersey? I mean, that's where they're based. Yeah. And by the way, that's where the money laundering problems came from, a small branch in the middle of nowhere. That's a lot of risk to take for modest returns.
Yeah.
Do you think that banks right now are adequately factoring in how tariff impacts, student loan repayment are going to hit household balance sheets from what you've heard thus far?
I think they are adequately reserved, but you make a very good point, which is that student loan repayments, if we're going to start garnishing wages and things like this, you will see that hit, particularly in the bottom quarter of consumers in terms of income and credit scores. The FHA market, which is typically where people would go to get a mortgage if they had a lot of student loan debt, you're going to see delinquencies go up. Will that affect bank earnings overall? No, because the rest of the credit stack is still pretty quiet. All of the action is on the commercial side this year. Consumers, we keep waiting for this consumer recession, right? And it hasn't materialized yet.
Yeah. All right, let's talk about the thing that I know you're really excited to talk about, Fannie and Freddie.
Fannie and Freddie.
One of your favorite subjects. The president once again reiterating the desire to privatize Fannie and Freddie. Now, the talk has been around for years.
Sure.
As you are well aware, and you've written a lot about, the devil's in the details. So what do the details need to be?
The reason they're talking about this is they need the cash in order to make their tax cuts and their budget reconciliation bill work. How do you get cash from Fannie and Freddie? When they take them out at the end of the day, say 2 years from now, the U.S. taxpayer is going to own 98% of Fannie and Freddie. And what I've written is I said, look, you need cash, buy out the public common shareholders, get rid of them. Leave the United States as the sole voting shareholder in the GSEs and issue a lot of preferred. You could create a new asset class around GSE preferred, single-digit coupon, and guess what? You could give the Treasury all the cash they need. And the other thing, Julie, remember, if they try and do a public offering with Fannie and Freddie, common stock, they may take a loss. they may not be able to get par value for it. So if I want to give them their cash and get the government out as quickly as possible, I think they need to restructure both companies, buy out the common shareholders, and maybe offer a buyout to the existing preferred shareholders. Give them a little deal. They've been waiting for 15 years.
Well, Bill Ackman's been pushing for this,
Yeah, but
right?
we don't need to create a plaything for hedge funds. There's no point in having private common equity capital in the GSEs. It does not affect the rating. The only thing that can backstop the GSEs is the United States. So for example, if we take the issuers private, we still have to have Treasury guarantee the mortgage-backed securities. Otherwise, it does not work. Remember, I worked at Kroll Bond Ratings. It doesn't work. Yeah. So if Fannie and Freddie have to pay Treasury, say 10, 12 basis points a year to cover their bonds, they may have to increase their guarantee fees. So there are a lot of pieces here that are going to have to be worked on, and they're just getting started. They did a lot of work on this in Trump 1. It's in the closet. They got to get those documents out, and then they got to find somebody to lead this process forward.
We got to go. What's the likelihood that this happens if you were to put a probability of this?
Oh, I think it's very likely because they need the money.
Chris, good to see you. Thanks for joining us in studio this morning.
My pleasure.
We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief.
That's the opening bell here on Wall Street. Let's do a check of the markets now as investors consider the fact that now the House has passed President Trump's tax bill. Now it will go to the Senate, but we have been continuing to see yields push higher, particularly on the longer end of the Treasury market, and that has caused a little bit of trepidation here in the market. So we continue to see a little bit of declines here. Right now, the Dow off by just about 0.25%, just over 100 points here as we open up the S&P 500, just off by about 0.1%, and the NASDAQ opening very, very slightly higher here. Let's get to the three market movers that you need to watch for the trading day. Yahoo Finance's Jared Blickery's got more.
All right, thank you, Julie. First on my list, these bond yields that you were just talking about, they are surging. The bond market is driving the bus, and as a result, stocks are whiffing today. They're taking a little bit of a tumble to the downside for the third day in a row. But then we have crypto, an entire asset class that is just surging with Bitcoin at all-time highs. So let's tick through this list. And I'm going to start with the 30-year. I'm not even going to start with stocks right now because, as I said, the bond market is driving the bus. The 30-year yield is up to 5.12%. I'm going to put a really long-term chart on this, and this goes all the way back to the 1980s, and we have not seen a level like this since 2007. And you can see this big downward trend line right here has been broken definitively over the last few years. All of this means that we are in a new market regime, and I think it's no coincidence that even President Trump is looking more towards the bond market this time around than to the stock market. Real quick, just want to go over the 10-year T-note yield, and I'll put an intraday. That was up early, but now it's down and just in a tiny bit in negative territory, not even down 1 basis point. Not a lot going on there. U.S. dollar index is up. So this is actually one of the good signs. We've seen the U.S. dollar index under a little bit of pressure the last few days. And my concern was this was developing into another situation that we had a month ago where it was sell everything in the U.S. Sell the U.S. dollars so you could get rid of your bonds and et cetera, et cetera. But that does not seem to be the case today. But then looking at stocks, let's take a look at the opening prints here. Looks like the Dow is still under a little bit of pressure. But check this out. The NASDAQ is now green. And if we take a look at the 4-day price action here, you can see we're still underwater. So stocks not doing the best this week. NASDAQ down 1.5%. S&P 500 down almost 2%. But we've seen other days like Monday where we're able to climb off of those early losses and sometimes even close in the green. And so given the positioning with the U.S. dollar index and everything else, we can hold out some hope for that by the end of the day. Want to get into some sector action, and energy was leading to the downside before the market opened. You can see it is still down 1.03%, but the leader to the downside now is utilities. And energy has been kind of a sore spot this week, and we can see over the 4 days, being Thursday here, it is down. It is leading down about 5.1%. You're also going to see all of these sectors here, all 11 in the S&P 500, those large caps are under pressure this week. So just kind of underscores this point that we are seeing stocks under a bit of pressure. I'll take a quick look at the NASDAQ 100 and get this back to an intraday view. Tesla was leading to the downside before the market opened. Guess what? It is now in the green, and Tesla's kind of been a leader both to the upside and to the downside of the Mag 7, which have been trading more or less in unison on the big down days. But when we're up, we have a kind of a mixed bag as we're seeing today. Alphabet up 1.35%. And now let me close with Bitcoin, because we have watched Bitcoin knocking on the door of those all-time highs. You can see it's up 4.58% over the last 24 hours. This high here, which occurred overnight in the early hours, almost 112,000, I believe, and it's holding 111,000 comfortably. And here's that year-to-date chart that I've been tracking for a number of weeks. We had this nice rounded base, a little bit of a cup, and now we have broken to the upside. So this may be the start of a next major leg up for Bitcoin. I would like to see the other risk markets, namely stocks, kind of follow in its footsteps, but that 30-year is still giving me pause. Just want to close with Ethereum. This is a year-to-date chart. Ethereum having its best day in a week here. It's up almost 5%, and not quite as bullish as Bitcoin is looking here, but it's making grounds. And I'm going to close with a 1-month view of all the coins here, and we can see we're seeing a lot of outsized gains. Bitcoin is not even the leader here. It's up only 19% over the last month, but we're seeing some of these up 50, 80% if you're looking at Ethereum and Monero. So the crypto space really kind of bucking the trend here as far as those other asset classes are going. Brad?
Jared, thanks so much. We're going to continue that conversation in a moment. It's time now for today's strategy session. The crypto rally sending Bitcoin to fresh record highs. But can the momentum continue? Joining us now, we've got Matt Hogan, who is the Bitwise CIO. Matt, great to speak with you once again here. Just take us into what's really prompted this most recent thrust that we've seen within Bitcoin, the leading cryptocurrency right now by market cap.
Yeah, absolutely. It's great to be here. We have two forces working together to push Bitcoin to new all-time highs, and I do think that rally will continue. One is that institutions are moving into the crypto space. We've seen over $8 billion in inflows into Bitcoin ETFs in the last 30 days. That's new demand against fixed supply, and that pushes prices up. But at the same time, we're getting a lot of unintentional support from Washington. I think the market today is reacting to the fact that the government has sort of said it's on board to grow deficits, to print more money, to expand the fiscal debt. And that's forcing people to look outside of fiat currencies to an alternative. Bitcoin is that alternative. I think this is the start of a major move. I think we're going to significantly exceed the previous all-time highs, and we're en route for another great year in Bitcoin.
Hey, Matt, it's Julie here. This has long been sort of one of the arguing points for Bitcoin, right, in terms of what you were just talking about. But the folks we're talking to don't think that the movement we're seeing in treasuries, for example, or the concern about deficits is going to be terribly sustained. It hasn't been sustained in the past. So what gives you the optimism that that flow is going to be sustained into Bitcoin this time around, if that is indeed one of the reasons why?
Yeah, look, I think something may have started to break with investors' long-term appetite for debt, right? We have the 30-year over 5%. We see what's going on in Japan. I think people are starting to realize that the U.S. government has given up on the idea of substantial cuts. Deficits are going to continue ad infinitum, and that means the long-term value of the dollar is in question over time. People want alternatives. I think that's adding significant flows. Even independent of that, though, you have this structural mismatch between new demand and supply with institutions coming in. So that's sort of like the cherry on top that's forcing us up today.
Matt, why is what's true for Bitcoin not true for the rest of the altcoins that we're watching?
Yeah, I think there's a real fundamental difference between Bitcoin and assets like Ethereum and Solana. Bitcoin is the world's digital gold. Its blockchain is designed to serve that purpose, and it's widely held as money. It's held by more than 10 governments, by the largest corporations, the largest hedge funds. These other assets are very exciting investments. We're very bullish on Ethereum, very bullish on Solana. But even though they're called cryptocurrencies, they're more like tech plays. So I wouldn't expect them to perform similarly. I think their correlations will fall over time. Look, we're bullish on both. I think investors should own both, but one is digital gold and one is more like a new version of the NASDAQ.
Matt, now that we've seen the spot Bitcoin ETFs, including the Bitwise one, mature a little bit more, IBIT is the dominant one, as you know, with about $56 billion in assets. What role does the Bitwise spot ETF play, and how should investors be thinking about the landscape of these ETFs that are pretty much the same, or should they not be thinking of them as the same?
It's beautiful that there are multiple ETFs and people can align with the one that fits their goals. So plenty of people love BlackRock, the world's largest asset manager. Some people in a specialist market want a specialist expert who's been managing investor capital in this space for the past 7 years, who understands how markets move over time, who is there whether the market is up or down. So when we speak to financial advisors, when we speak to institutions about BitB, they want to align with a specialist that they know they can call and get on the phone to explain what's happening on days like today or days when the market is down. That's the unique value add that Bitwise provides.
You know, Trump is set to have another crypto dinner, and when I think about the last one, what took place was he launched his own coin while he had all of these other people in the room. What's anticipated this time around, and is the president having his own cryptocurrency, or his own coin, I should say, and digital currency? Is that something that erodes trust in crypto more broadly, or does it just push people further into Bitcoin?
I think largely it's a distraction, to be honest. If we look over the past 4 months at what's come out of DC, it's been extraordinarily positive for crypto. We've seen a 180-degree turn from the SEC, from anti-crypto to pro-crypto. We've seen a stablecoin bill moving forward in Congress. We've seen an executive order that established a Bitcoin strategic reserve. I do think the Trump meme coin on the margin is negative for crypto, but there is so much good news embedded in the market. In fact, I'd argue that one of the reasons we're surging today is there was so much positive news out of Washington in the first 3 months that it was sort of lost amidst concerns about tariffs and the tariff tantrum, and that is now acting as a springboard. So yeah, I would say the Trump meme coin stuff is probably negative for crypto on the margin. We get questions about it from institutional investors, but it's not the real story. The real story is underneath, where we've had this fundamental change in DC's approach to crypto that's put it on the path to be an institutional asset. That's why we're at new all-time highs and why I think we're going higher still.
Matt, thanks. Good to see you.
Thanks for having me.
Coming up, the battle of the retail giants. What's next for Target as Walmart pulls ahead? That's next on Morning Brief. The battle of the retail giants. Target cutting its full-year sales outlook, warning on the impact of tariffs, and Walmart maintaining its full-year outlook. It did warn of price increases due to the trade war. Joining us now, Jerry Storch, Storch Advisors CEO. Jerry, it's good to see you. Let's talk about Target here specifically, because obviously there's a lot of concern about it being able to turn itself around here. What do you think?
Well, I think that this is a broken story. They're operating in a way that is off strategy. They're not who they're supposed to be, if you will, and who they've always been. And meanwhile, they're not executing well. Other than that, everything's great. Meanwhile, Walmart is firing on all cylinders, continuing to reinforce their low price position and executing beautifully.
Jerry, you think about some of your own service as vice chair of Target in the past. To the extent that you still have the pulse of those who are still on the board of directors here, what are they discussing right now? What are they thinking of Brian Cornell and the leadership?
Look, I can't speculate as to what the board might be thinking about. I can walk into the stores, though, and see there's a lot wrong with the business right now. And it's kind of been a string of, I hate to use this word, but of excuses that they've given on their earnings calls for many, many, many quarters now, starting from the pandemic till now. They were talking all the time about retail theft and what a big problem that was. And that's a real problem, but it affects everyone. And it doesn't affect them uniquely, yet they have been performing uniquely poorly. Similarly, they have had this distraction related to DEI, where at first they were in trouble for going too far, and now they're in trouble because they pulled back. And again, I'm sure that affects their business somewhat, but it's not what's wrong. at the core of the business. So it's the consumer's stressed. Of course, the consumer's stressed, but that doesn't seem to bother Walmart's consumer. They seem to be doing just great. So essentially, Target, as they sit right now, is just not Target. I mean, their prices are too high. They're high-low all the time with all these offers and buy one, get one, or get a discount or get a gift card, a loyalty program that saps the low price positioning because you only get the best price when you're on sale. The stores are not clean like they used to be. There's fixtures intentionally in the aisle, which would have been grounds for dismissal if you went to visit a store and saw something in the aisle in the passage. It's just not Target right now.
What lessons can Target maybe learn from what Walmart has been doing correctly over the past few years?
Well, you have to be who you are, and they're not exactly the same, even though we have a tendency to say they are. They're both discounters, but Walmart is a low price discounter. For Target to succeed, they have to differentiate themselves from Walmart. They can't look like Walmart when you walk inside. And right now, they just look too much like Walmart. I mean, while the prices are higher. So what's the point? And I think that's what the consumer's feeling. They're still, have some wins now and then where they do a collaboration with Taylor Swift or with a designer or that kind of thing. But those things are really, really tiny, in the scheme of the absolute business. There's some fundamental strategic issues beyond that. They have de-emphasized grocery relative to the rest of their business. When you compare Walmart, who's the world's largest grocer. And so grocery drives frequency. Consumable products drive frequency. And Target has been relying very heavily on nice-to-have products, but not must-to-have products. And that has been absolutely incorrect in this environment. But this environment is lasting for years. And so eventually you have to deal with it. So fundamental business issues are at the core of what's going on here. And they have to take ownership of that and fix it. And it starts with, what's the strategy? Who are we? And then once you have that, which I think is pretty clear because it's only been clear for like 50 years, so why would you change it? Then it's how do we execute against that, which they're not doing either. I mean, there's lines to check out. It was always the fastest checkout that you could get at Target. Their out of stocks are too high. They're just serious business issues right now.
And so as we're going through the compare and contrast of Target versus Walmart, for Walmart, reporting from the Wall Street Journal that there's going to be around 1,500 corporate jobs that are going to get cut at the same time as the company raising prices in specific categories here. I wonder what would lead the management team knowing that they're already willing to essentially say, hey, we're raising prices because of tariffs, which could upset President Trump and draw that attention and has drawn that attention. What also at the same time draws them to say we need to make these strategic cuts at this juncture?
Right. Two totally different issues. They said they're different. I believe they're totally different. They're always looking to operate a low-cost basis. That's who they are. Again, that is the core of what Walmart is about. I've been there several times, by the way, in my career, and visited with the CEOs, and I've been there a lot. They used to operate out of an old high school gymnasium, is what it felt like. You go there, you couldn't believe the place. They have newer, nicer buildings now. But having said that, they've always had a focus on keeping costs low. And so if they see an opportunity to lower their corporate expense structure, which I think they have to do as overhead that doesn't contribute to low prices, they're going to do it. So I don't think that's anything particularly special. I think that's what they do all the time, is look for places to cut. So I put that aside as something that is unrelated to everything else going on. In regards to the tariffs, I'm sure they'd like to have their earnings call back. I think that was an unforced error, what happened on that earnings call, where they mentioned that some of their prices would have to go up because of tariffs. I don't know why they said it, what they were trying to do, whether they were trying to political jawbone or, what was going on there. But the reality is 2/3 of what Walmart sells is food and consumables, which are almost entirely unaffected by the tariffs. A lot of it's sourced right here in the U.S. Certainly the prices for some products are going to go up, particularly branded products where the branded vendor might pass along a price increase. And so they feel like they have to do it. But by and large, they could have said exactly what Home Depot said, which is that generally our prices are not going to have to go up, which is true. Prices on some items are going to have to go up. But believe me, Walmart is going to negotiate with suppliers, do other things. As long as tariffs are in that kind of 30% range where they are now or lower, they're not going to have a material change in their price positioning. It was a ridiculous thing for them to have said. It drew all these headlines. The headline writers went crazy, and it doesn't really apply to them any more than anybody else.
Jerry, got to have you back to continue the conversation. Thanks so much for sharing the insights and analysis.
My pleasure.
All your markets action straight ahead. Stay tuned. You're watching Morning Brief. Oil prices falling after Bloomberg reported OPEC Plus is considering a third consecutive production increase for July, prompting supply and demand concerns. Here with more, we've got Yahoo Finance senior markets reporter Inez Ferre to break it down. Hey, Inez.
Hey, Brad, and this certainly supports the idea that OPEC Plus really has abandoned its strategy of keeping prices higher by doing cuts. Namely, they have been out doing these output increases over and over now. So they first remember that they first announced that they were going to increase the output on barrels of oil by 411,000 per day for May. Then they announced another 411,000 per day for June, and now they're considering the same amount for July. Now, this doesn't come as too much of a surprise for Wall Street analysts. They have been predicting that OPEC Plus would do this again in July. And the reasons for this is, one, to regain market share because they have lost market share over the last several years. The other is also to punish some of the members that have been increasing more than they should have because of their quotas, and also to get into the good graces of President Trump. Remember that OPEC is led by Saudi Arabia. There is a good relationship there between Saudi Arabia and President Trump. And Trump has very explicitly said that he wants the price of oil lower. I spoke to one analyst that told me OPEC holds the cards when it comes to the price of oil right now. And Goldman Sachs is predicting this is why we're seeing Wall Street has been lowering their price target on oil, because they're predicting now that oil is going to average for Brent $60 per barrel for 2025 and $56 per barrel for WTI. If we take a look now, we're seeing that you've got Brent down more than 1% right now, but year to date, down 15%. For WTI year to date, we're down 17%, guys.
Inez, thank you. Appreciate it. That does it for Morning Brief. Join me in the next hour for more analysis on catalysts, and then Brad will be back for Wealth at 11 a.m. Eastern.